What does that mean to you? When you hear the Fed chair say we, quote, can't fail, can we define failure here when it comes to the Fed?
Well, if we look at the Fed's mandate, they've got two things they can fail on. One is inflation and two is unemployment. And I think that's where they're in a real bind, because it's harder for them to see how they can get that inflation down without increasing those rates of unemployment. So, for the Fed to come out of this a winner is going to be a difficult situation. But I think it's been interesting to see the market movements actually in light of those comments. We've actually started to see, yes, maybe some expectations of earnings coming down. We've also seen bond yields falling as well. And I think that's been an important support for the markets in the past few days.
Is the market here, UK, Europe, because we're all kind of doing the same thing. We're all going down this year. Are the markets pricing in a soft landing or a hard landing? Because if it's a hard landing and we get a soft landing, that should be good for stocks. And of course, if the opposite is true, that should be bad.
Right, so we think at the moment we're probably pricing in a soft landing, so something like flat to slightly down earnings next year, bond yields staying roughly where they are. Maybe the Fed can get inflation down steadily, but not dramatically. So we think that's roughly what's getting priced today. Now, in the hard landing scenario, we think that you're getting earnings down maybe 15%. Now, that scenario isn't yet priced today. But as I said earlier, when bond yields start to fall as well, that's probably when we start to see a floor coming into the market, because for every percent you start dropping earnings, you start dropping your bond yields by a few basis points, and that starts to create support. So we'd say about 10% downside to that hard landing scenario. Today we're pricing in this sort of softish scenario of flattish earnings for next year.
Well, I guess that's a little bit of comfort, which is that if we get the hard landing, maybe another 10% down, which is painful, but not the end of the world. Although, would you expect a sharp, sudden rebound in equities globally if that happened? Or could it be another one of these 2-year slog down, down 2, up 1 type scenarios?
Well, as you said, I mean, if the market starts pricing in the hard landing, and then it turns out that in 2023 data turns out to be more positive, perhaps inflation becomes more under control more quickly than we currently expect, then of course you could see that sharper rally. I think the danger, of course, if you do enter that hard landing scenario, is there leverage in the system? Are there parts of the market that we haven't appreciated as being at risk? And that's often the case. So I wouldn't expect it to be a sort of bounce back off a low in a hard landing scenario. It could take a while to find the bottom, and we'd expect to see continued volatility in that environment. But once you start to get that positive data coming through, then you get that rebound.
And Kiran, quickly, I know from your research, you guys like what's called the end of security type trade. Very quickly, explain what that means.
Well, we've had Russia's invasion of the Ukraine, and almost regardless of what happens there, whether we get a continuation or a ceasefire, I think it really has focused the minds of governments, of businesses, of individuals, the paramount importance of security and stability. Perhaps in the past, efficiency and prices has taken precedence, but security and stability being really key. What do we mean by that? Well, things like energy security, agricultural yield enhancement, investment in new food technologies, cyber security, all of these areas are going to be very much in focus over the coming years, regardless of what happens in Russia and Ukraine, because of what's happened and the refocusing that's led to in the mindset of businesses and government.